Oh, it was not just another manic Monday. It was chaotic. It was high anxiety time. The closing bell bringing to a close what was a huge sell-off in the Dow Industrials today. At one point, it dived more than 1,000 points. That's the largest intraday point drop ever. The Dow managing to cut its losses. By the close, it was down about 500, nearly 600 points. Question, is the worst over? Welcome, everyone. I'm Stuart Varney in for Neil Cavuto, and this is Your World. And we are all over this one with Rick Leventhal on what sparked it, Trish Regan on how Main Street is dealing with it, and Donald Trump on how he predicted it, Jim LeCamp on where we go with it. We begin with our Rick Leventhal outside the New York Stock Exchange. Rick.
And Stuart, this was a dramatic and serious plunge with, as you mentioned, the Dow tumbling nearly 1,100 points within minutes of the opening bell. This was a drop of almost 7% and the largest intraday point drop in the history of this market, which opened more than 200 years ago. Of course, this sell-off followed a very bad end to last week when the Dow dropped about 3%, roughly 500 points on Friday alone. And investors were hopeful earlier today when the massive declines eased significantly. By midday, it was in the red, only about 1% off the high at lunchtime. And all of this not a surprise to us, including for financial advisors, including my own, who told me that he believed a market correction of 10% was long overdue. He and others also believe that there's plenty of stability in this market, so there wasn't a whole lot to worry about. But don't tell that to the older people who are nearing retirement age and anyone who's trying to buy a home around this time, because these are very difficult times for those investors. The biggest losers today include United Health, Cisco, and ExxonMobil, down several percent. And of course, these latest nosedives being blamed on what's been called the Great Fall of China, where shares today dived nearly 9% overnight with huge sell-offs and a sharp drop in Chinese currency. That was their biggest percentage drop in Shanghai since 2007. Analysts are also saying that the bleeding could and probably will continue there because of the overall slowdown in economic growth. The banking system there is short on cash and investors pulling their money out. Also, Japan's Nikkei index down 4.6%, its worst one-day drop in 2.5 years. The European market's falling hard too. Again, Stuart, as you mentioned, there was some bit of a rebound late this afternoon after that horrific start. The market closing down more than 570 points, and Nasdaq down 175, and the S&P down roughly 76 points. So a tough day here on Wall Street, Stuart.
Yes, indeed. Rick Leventhal. To Harry Dent, who says this is a major bubble bursting. Harry, you predicted for some time now the Dow would drop to 6,000 over the next 2 years. You say that this is the start of the big sell?
Yes, I mean, you got to put it in perspective, Stuart. As we've seen, we've had the greatest bubble boom in history starting in 1983, and people talking about a 7% crash today in one day. In 1987, there was 20% in one day and 40% in 2 weeks. And we've just seen China go down 35%. The difference is China's at the end of a major bubble that's been building for decades. So is the U.S. and most of the world. When you get a bubble like this, especially when it is fed by massive credit expansion, quantitative easing on top of that to keep the bubble going. When these bubbles burst, they don't just correct 10 or 20% and go on. They burst. They crash. I've studied history, and anybody argues otherwise, I want them to give me an example.
Well, Harry,
so yes, I think this is the beginning of something that is going to go much lower over the next, by late 2016, early 2017.
Now, Harry,
how it gets there, I don't know. It's
you
going to be
believe
like this,
that everything goes down. You think everything goes down, from stocks to gold to oil. It all goes down. That's what you're forecasting.
And that's already been the case, and we've been predicting this for years. We've been saying China's the epicenter, that commodities go down because China's slowing, oil goes down, that kills our energy and fracking industries, which has huge debt in the frackers. I mean, this thing reverberates. We triggered the last crash in 2008 with our subprime crisis. China is the biggest trigger in falling oil prices. But in the end, since everything is bubbled up, and this only happens once in a lifetime, like in the Roaring '20s, everything goes down as happened in 2008. What did not go down in 2008 is what I ask people.
Okay, here's my question. Is this inevitable? Is there anything any authority anywhere can do to fix this before this crash occurs?
Well, you can't fix it, but you can kick the can down the road. What I've been telling people, Stuart, is we've seen this bubble keep going up and more QE here and more QE there and more bailouts there. Something's got to happen that the central banks can't control. We don't have, the Federal Reserve does not have control over this bubble bursting in China that is so extreme I could spend an hour on it alone. Nobody is buying oil futures, central banks, to keep oil from continuing to collapse because that would sound crazy. It's one thing to buy your own treasury bonds that are fairly safe, and not as safe as people think, but fairly safe. But to buy oil futures to prop up an oil market like China's buying their own stock, that wouldn't be happening. So these are the things: the China bubble bursting, oil going down, which will trigger many countries to fail, many global companies to have problems, but mainly our frackers are going to be defaulting like crazy on $300 to $600 billion in debt over the next year, and that's just enough to trigger a broader debt crisis. We've
got a lot of viewers who are watching who have some money in the stock market. What should they do? Are you saying sell it now while the going's good?
I'd say sell on bounces there. We've had a big downturn. We've been telling your viewers and our subscribers, get out of the bubble a little early, because we've studied bubbles, and when they burst, it's usually 30 to 40% in the first 2.5 months. So I think this is extremely dangerous. We're in the crash season where you get the worst crashes, mid-August to mid-October. We've just started that, and we're already seeing it. I say any decent bounces, especially this week, I'd be saying yes, use that as a chance to get out. It may go higher, it may go lower, but you see the volatility. Nobody should be sitting through this.
All right, we hear you, Harry. Thank you very much indeed. Harry Dent right there. All right, everyone, take a look at this. The Dow Jones Industrial Average started out the day at 9:30 Eastern Time. Within 5 minutes, we were down 1,089 points. Some buyers came in, and the market came back a little. There were bargains at Apple, GE, and some others. More buying, down 300. Even more buying, down 200 points at 12 noon. And by the early part of the afternoon, we were actually down just under 100 points. At that point, the selling began all over again. Down 300, down 400, down 500, 600 points by 3 o'clock. The final closing number 1 hour later, down almost 600 points on the day. That's what happened on Wall Street today. To Jim LeCamp, who says this is no time to freak out. What do you mean by that, Jim? Don't sell, don't panic, stay in there?
Well, first of all, Harry Dent's got a problem, and his problem is that I've got a good memory. I remember back in the late 90s when he was wildly bullish, the most wildly bullish forecaster on Wall Street, bombastically so, talking about the market going over 20,000. This is in 1999, right before the 3-year bear market. Then he gets bearish right at the wrong time, right after a 3-year bear market, and the market recovers for the next 5 years. Bombastically bullish, gets bombastically bearish. He's been calling for this massive sell-off for the last 3 years. Look, I don't disagree with the debt, with the bubbles. I understand all of that. But at the end of the day, the United States economy is growing. We're going to benefit from some money flows because there's problems in China and there's problems in Europe. The U.S. looks better by comparison. What's happened to interest rates as the market has sold off? Interest rates have come down. They're about 2% now on the 10-year Treasury. Where's money going to go? I think it goes back into the stock market. Okay. Are we going to be volatile between now and probably mid-October? I think so.
Look, our viewers are seeing a chart of the Dow Industrials over the last 20-odd years. What you see is the dips are quickly replaced by an upside move. The bottom line from that chart is when you see a big drop like we've seen for the last 3 trading sessions, stay there and you'll get your money back within a short period of time. Is that your advice?
Yes, it is. And listen, for 401k investors, they want this kind of volatility. They want stocks to be cheaper from time to time. There's a tendency for everybody to rush out and get bearish the first time we see this kind of a sell-off. And on a percentage basis, this isn't that unusual of a sell-off, Stuart. We just haven't seen any over the last 3 years. But we saw it in 2010. We saw it in 2011. We've seen it over and over again, and it's been a buying opportunity. As long as the Fed doesn't get over-aggressive and raise rates too much, which I don't think will happen, as long as we don't go into a new war or into a new recession, I think equities are going to be a better place to have your money than other asset areas.
Look at what some people were buying Apple at, 92, and it closed above 100. Look at Netflix. It went down to 85 and closed at 96. If you've got a very strong stomach and you like a particular stock, you could jump in and find a bargain. But you know,
and
that's for the very, very decidedly bullish investor who knows a bargain when he or she sees it.
Look, a lot of these corporations, and the ones you mentioned, are doing very, very well in this economy. There's a tremendous amount of industries and industry groups. Healthcare is one that's been one of our favorites that are growing very rapidly. Technology, you mentioned, growing very rapidly. A lot of consumer discretionary areas, especially the restaurants, doing very, very well. These companies are creating wealth for people, creating wealth for investors. Yes, the market can be more volatile. We can see another dip down. But unless interest rates get away from us, I think the stock market is going to create more opportunities on dips than times that you should be selling.
All right, Jim LeCamp, we hear you. Thanks very much for joining us, Jim. Move on to oil prices. Crushed today. Crude down another $2.21. It's now just above the $38 a barrel level. On a more positive note, gas prices continue to move lower. Regular unleaded now has a national average price of $2.60 per gallon. China behind it, and Trump is running with it.
I've been telling everybody for a long time, China's taking our jobs, they're taking our money. Be careful, they'll bring us down. You have to know what you're doing. We have nobody that has a clue.